Are you looking to purchase a home and want an overview of different loan options? Are you a real estate agent who's looking to further their knowledge on loan features? Well, if so, this podcast is for you. We'll be reviewing 7 different loan features, and we'll even discuss one that may potentially be a bit of a scam or at best, poorly explained. Before we go any further, please hit the like button and subscribe to our podcast. With that, I'm Joe Harris, and I'm here with Nick Morgan, also from Morgan Financial. How you doing, Nick?
I'm doing great, Joe. How are you?
I'm good.
Awesome.
So what are we talking about today?
Yeah, so we're going to be talking about, like you touched on briefly, these different loan features or options or products, however you want to describe it, but that may be presented to you by a lender of whatever sorts.
Okay, cool. Good deal. Yeah, there's a lot of things out there. Most of the time people say they don't know. They just want a 30-year fixed rate loan, right? But there are other options out there. There's a fair amount of them too.
Yeah. And as we know, the 30-year fixed rate is the bread and butter.
Right.
Do you want to go over that briefly real quick, just so people know what we're talking about when we're talking about fixed rate?
Sure. You know, the 30-year fixed rate, the 30-year means how many years the loan is amortized over, okay? 30 years, 15 year. And actually, we had a video on this recently. We'll put it at the end.
Yes, and I'll put the link up somewhere that you can click on it.
Somewhere up
somewhere.
Here. So the 30-year means the term of the loan. It's a 30 years. So you have 30 years to pay off that. You're going to pay it off on a specific schedule over 30 years. Obviously, most loans allow you to prepay.
Yep.
Right. And the fixed rate means that rate that you lock in at, the rate you have at closing is going to be the same rate you have throughout that 30 years.
Right. So, and every payment is the exact same 30 years. Yeah.
Well, mostly until the very last payment, it should be whatever's left.
Yeah,
right?
Exactly.
So,
yeah.
Cool.
And so, these loan features or options are going to be tweaking that fixed rate, essentially kind of making your payments different or varied throughout the process. And if we want to get right into it, the first one is probably the next most common loan is ARMs. And what does that stand for?
And ARMs are adjustable rate mortgages. And so ARMs typically have 2 components that make up the rate. They have the index. So an index would be, the prime rate is an index. They don't use those for ARMs typically, but it's an index that gives it a base rate. And then there's a margin on top of that. And the margin's actually the money that the banks actually make on that loan. So the index and the margin make up the rate. Now, the adjustable rate mortgage are just that. They're not fixed for the life of the loan. So when you close, typically there's a term of how it changes. Some of them are fixed for 5 years, and after that they go variable every 1 year. That's called a 5-1 ARM. There's other types of ARMs out there that might adjust every 6 months. Some of them have a fixed period for 3, 5, 7, 9, 10 years, and then they go variable after that. Some of them are never fixed, right? And they adjust every month, every week. I mean, not every week, every year, every 6 months. It just depends on the term. So if you're out there shopping for a adjustable rate mortgage, the advantage typically is that they have slightly lower rates, right? Because if you're willing to take the risk away from the bank, because remember, if a 30-year loan, that lender is stuck with that rate for 30 years, no matter what the market's doing.
Right.
So there's a risk to them. So the rate is going to be a little bit higher than if the risk is lowered to the lender by saying, on that adjustable rate mortgage, that it changes more often to keep up with the times. But there's limits on how much they can adjust. If it can only, the max might be 5% over the initial start rate. It could be adjust every year after. It could be every 6 months. So there's lots of different features. If you're looking for an adjustable rate mortgage, understand exactly what you're getting into and make sure the loan officer explains to you how often it adjusts, what are the criteria for adjustment, how high could it go, and could it go lower?
Totally. Yeah, totally. And you don't want to get stuck in what we call payment shock, basically, where it adjusts and you're like, whoa, what happened? Because maybe the market did something, or maybe there was a way the payment increased or whatever.
Right. If let's say it's an old school 5-1 ARM, it's fixed for 5 years, and then after that it goes variable every year. Well, the initial rate adjustment could be as high as 2 to 5%, depending on the documents that you signed at closing. And most of them might be 2% for that first increase. But if rates have gone up a lot And you're going to have a pretty big payment shock when your rate goes from, let's say, 5% to 7%, right?
Yeah.
And you need to know that all ahead and be prepared. Typically, I wouldn't do an adjustable rate mortgage unless I knew I just wasn't going to be in the home after 5 or 7, whatever the initial start rate was.
Definitely, like just short time periods.
Right.
Yeah. Awesome. So a second one I have is kind of like a 30-year. It's basically a 30-year fixed rate, but a jumbo loan. How does that differ things? People throw out the word jumbo loan.
Jumbo,
Does
right.
this mean it big or?
It is big,
Yeah.
right? So yes, a jumbo loan means that it's above the conforming limits. Now, what's a conforming limit, Joe? Well, Fannie Mae and Freddie Mac, you might have heard of them. Those aren't even their official names, but they basically buy loans in a secondary market from lenders out there. As long as the lenders write to their standard, the underwrite to their guidelines and standards, they will buy these loans in a secondary market. And that gives lenders and banks and other mortgage companies like us money to lend back out to the next borrower, right? So we're not encumbered by all these loans we have out. We would only be able to loan so many times per year.
Right.
So we do these loans, we sell them to Fannie Mae and Freddie Mac, and that's considered a conforming loan. And the conforming loan limit right now, I'm going to hopefully get this right, $766,000, I think it's $250, somewhere $766,000 and change. It might be $450, $250, I forget. That's why we have guidelines I can look up very easily to tell you that, but I don't have it in front of me. So that amount, that conforming amount, if it's over that conforming amount, it's considered a jumbo loan. And so Fannie and Freddie, they will buy what's called a conforming high balance jumbo. So in certain markets, they'll go higher than that 766, 450 or 250. They'll go above that amount. But in most markets, they won't. All right. So if you're not in a high balance conforming area, then if you're gonna go over that 766 and change, you're gonna need a jumbo loan. Okay. And so jumbo loans are typically made by banks or different investors or portfolios out there. They're not as prevalent as the conforming loan. There's not as many of them done.
Yeah.
Their rates could be a little bit higher because it's a little bit more risk, but sometimes banks make those very attractive. Sometimes they do.
Yeah.
Because they want your deposits, right? So they're saying, look, if you can we'll do this jumbo loan for our, our clients, and we're gonna benefit them with a decent rate, and they're gonna have to make those payments out of our bank accounts.
Yeah.
So that means you have to put money in there. So they're gonna attract your deposits, and that's kind of their cost to do so.
I gotcha.
Does that make sense?
Yeah, no, it totally makes sense. It's so it's typically banks then just portfolioing the portfolio.
They might, yeah. I mean, we're not a bank; we are a mortgage bank, but we have means to do jumbo loans, right?
Yes.
We're not portfolioing. We're not going to hold those $1 million loans on our balance sheet.
Right.
We're going to sell those loans off in a secondary market or have a prearranged situation.
Yeah.
And we'll have someone service them. But that's typically like people are looking for the jumbo when they're just exceeding that conforming amount. And they are a little bit harder on guidelines, underwriting, the debt to income, the credit score, the loan to value. Like I don't think there's a lot of 100% jumbo financing out there right now. Not even 5% in some cases. You might need to put down 20%. You might need a little better credit, a little lower debt versus your income and things like that.
Right. That's why we love VA, because however high you want to go.
Yeah, VA doesn't technically have a loan limit.
Yeah.
So yeah, we do love for the veterans out there, that VA loan. You really can't beat the VA loan.
It's awesome.
It is unbelievable.
It's awesome. All right, sweet. So the next one
Qualified borrowers. So
the next one I have is a buy down. Numbers like 3-1, 2-1 buy down. What does that mean?
Okay, so this became popular when rates started going up. The buy down means that there's a set term, whether it be if it's a 2-1 buy down, that means for the first year, your interest rate's going to be 2% lower than your note rate. The second year, it's going to be 1% lower than your note rate. The third year, it's going to go to whatever note rate it was. Now, the advantage of this is it helps you ease into that payment, right? And a lot of people don't tell you, a lot of lenders don't tell you that the cost of the buy down, what you'll pay for it up front, is exactly your savings over time. So think about that. You're going to give a lender, let's say it costs $10,000, but let's say you save $10,000 because the first year you had 2% reduction, the second year you had 1% reduction.
Right.
Let's say you saved $10,000. That's exactly what that buy down is going to cost you at that lender. You have to give them that money up front at closing in order to so I give you 10 grand and you just give it back to me over the next 2 years. This does not sound like a smart option.
Yes.
And people will tell you, well, no, the builder is going to pay for it or the seller is going to pay for it, right? So the seller is going to give you $10,000 at closing. You're going to give that $10,000 to the lender, and the lender is going to give that back to you over the next 2 years if it's a 2-1 buy down.
Right.
Why? Why wouldn't you just want your money at closing?
Right. Yeah.
So if the seller is going to pay 10 grand in closing costs, I would rather reduce my costs at closing by 10 grand.
Right. Exactly. Basically take 10,000 off the top of the price. Right.
Yeah. So that means you get to keep $10,000 more in your pocket. So I don't understand the logic behind this in the last couple of years. And we can do these loans, but a lot of clients, when we explain it to them, we educate them that, hey, look, when you give them $10,000, they're just going to give you that money back over the next 2 years and no more than that money.
Right.
And they're like, why would I do that? I go, I am not sure. In most cases, there are a couple of cases where it actually works, but those are few and far between. And I can't think of an exact situation on hand that I'd rather.
Yeah, it's tough, right?
It's
you're
tough.
Basically just, here's my money, give it back to me later. You know what I mean?
Yeah. We had a lot of competitors selling this 3 years ago.
Yeah.
They're saying, well, you can just refinance. The rates are going to go down and you can refinance and then you're going to have a lower rate and you get some of that money back. Okay, well, it's been 3 years. That 2-1 buy down's long gone.
Right.
Now those people's payment has gone up. They probably already had other uses for that money because they're not used to paying that. And now they're probably going, why did I do that?
Yeah.
Right.
Yeah. And I know you always touch on, don't get into a loan planning on refinancing.
You never know what the market holds.
Yeah.
If anyone knew the future, they would be giving those predictions from their 400-foot mega yacht, because no one knows the future. No one knows what's going to happen next. And we've even predicted that rates are going to go down and we'll eventually be right. but predictions are just that. They're guesses about the future based on specific information. So going back to 2-1 buy down, if you're being sold this in the marketplace, ask a lot of questions because money now is worth more than money later. So if I'm going to pay money now, I should get a discount over time, but you don't with a 2-1 buy down or a 3-2-1 buy down or whatever it is. Yeah. It's a high cost up front that could have been used to pay other closing costs, to reduce your out-of-pocket expense, and you're giving it back over a set period of time, but no more or less than you gave up front.
Yep.
Doesn't make sense.
Yep. Totally agree.
In most cases.
All right. Awesome. Well, let's move on to number 4. I have an interest-only loan. Does this exist for mortgages? And is it a good idea?
Look, there's no loan that really was terrible in the past. And Joe's like, there's all these terrible loans. No, they were given to people that didn't know how to use them properly. So an interest-only loan has a place, but I can't tell you. I haven't really seen an interest-only loan in 15 or 16 years,
right?
Other than outside of an equity line or a second mortgage. On a primary residence, yes, your house may appreciate, but you also don't want to bank on appreciation. It's nice and it happens, and it's actually been a constant over the last 100 years. Over time, homes have appreciated. But you also want to use your house as a forced savings account. Right. So that's why you want to pay principal every month. Interest only gives you a lower payment because you're only paying interest. Technically, if they even existed in big force right now, which they don't. Yeah. But it doesn't make a lot of sense because you're not paying in principal to your home.
Right. Yeah.
So at a certain time, that principal, that interest only, they're going to want their principal back
eventually. Yes.
So a lot of those back in the day, they were set up 10 years interest only, then it switches to a 20-year AM on a 30-year total loan. Well, again, 10 years interest only, and then that's going to be some serious payment shock going from an interest only payment to a 20-year amortization.
Yep.
The payment on a 20 years greater than a payment on a 30-year, right? Payment on a 15 years greater than a 20-year. So no, I don't really think they exist out there a lot. There's probably some what they call non-prime loans or non-QM loans out there that have these features. I certainly don't recommend it for the masses. There may be a few people that it works great for, right? But I haven't seen one of those in a while.
Yeah, it's loans like this that people get caught up in, and then like you said, you're in a 20-year amortization period from an interest-only payment, and that is like severe payment shock, and that's when foreclosures happen.
Yeah, they get caught up in that false confidence of, look,
Yeah.
I got 10 years to figure out how to pay the interest. And again, I don't really think these loans exist in full force.
Yeah.
So this isn't really a big option right now that people will consider.
Gotcha. Awesome. All right, so moving on to number 5, I have a feature called a balloon payment. And if that's attached to my loan, what would that be?
Again, same thing. This was, let's say you had a $100,000 loan and the balloon payment says after a certain amount of time, whatever principal is left over, that's due at that time. So these things were crazy back in the day. They were widely abused, improperly used, and caused a lot of problems because people would just pay the minimum payment and run along, and then all of a sudden they get this bill for, a couple $100,000 that's due in a certain amount of time. And that caused problems. So you're not going to see this balloon loan type out there. You might still see them on car loans, but even then, you might be able to refinance that into if you're positive. But I don't see it much in real estate transactions right now, and I certainly wouldn't consciously recommend that.
Yeah. So if someone is offering you a balloon feature, ask
again.
Yeah,
ask a lot of questions.
Yeah, be careful.
Ask a lot of questions.
Yeah.
I mean, I would assume it'd come with a rate out there that it just wouldn't make sense.
Yeah,
maybe for some non-prime is what they're calling them, non-QM, non-prime loans. I don't know. I just don't see that as being a feature. It might even be illegal right now.
Awesome. All right. Number 6 I have is a little bit different. It's what is a HELOC? I get this term thrown out, and I have no idea what that is. What is a HELOC?
Okay. So a HELOC, HELOC.
Yes.
Did I get that right?
Yes.
Okay. Home equity line of credit. All right. So typically these are second position mortgages. So you have a primary loan, a first position mortgage.
Right.
And then it'd be in the second lien position. Typically, not always. And they're typically, I'm talking in general terms, they're typically variable rates. And they're tied to the prime rate plus a margin. Okay, so the prime rate is determined by the federal funds rate plus a margin, and then there'd be something else on top of that. So, if the rates are 6-7% right now, and that's an estimate, not a quote, HELOC rates might be 8-9-10%. Okay, so they're typically going to be a little bit higher, and they work kind of like a credit card. So and they have, a lot of them are interest only, or they could be interest only. They could be a fixed rate, but it might be a little higher fixed rate.
Yeah.
And they might have some kind of amortization. But there's fixed seconds, and then these home equity lines of credit are typically open-ended. In other words, you can pay it down and then run it back up, pay it down just like a credit card.
Yeah.
So it runs off your home's equity. So if you have a lot of equity or value in your home that's not encumbered by a lien or a loan, that you can, I say pull from it, but you can you can borrow against that equity in the form of a home equity line of credit. Okay. Again, it's typically a second mortgage. It could be a primary. If you have no existing mortgage on your loan, you might be able to get what we call a first position HELOC, and it's going to be used like a credit card, so you can pay it down or run it up at your will.
Yeah.
A lot of them are 10 years interest only or 10 years smaller amortization. Then they might flip to a 20-year loan. Those are typical features. But just, again, make sure you understand. Make sure you understand what is the rate tied to. Is it fixed or is it variable? Will it change? Will my payment change? How might it change? When might it change? These are all questions that if your loan officer doesn't tell you, you need to be asking.
Gotcha. Awesome. Sweet. The last one I have is number 7, a reverse mortgage, which is, basically a completely different kind of thing, right?
It is. So you can use reverse mortgages in a couple of different ways, but the main ways I've seen people use reverse mortgages in the past is to purchase a home. Believe it or not, you can purchase a home with a reverse mortgage, or to pull equity or cash out of a home. Now, it does require of you to be of retirement age. I think it's 62 or 65. I don't know because I haven't done one of those in I did one about 16 years ago.
Oh, beautiful.
Okay. It's not what we're not experts in that. We don't specialize in that. There's lenders that only do reverse mortgages. And that's who I would seek out for a reverse mortgage is someone that does it all the time, understands the nuances, and they're using it correctly. Okay. Now there's a lot of negative stigma that goes around these things. Like sometimes the family of the borrower is at odds with the borrower over these things because they believe they're going to lose the home.
Yeah.
Right. But remember, this is the reverse mortgage borrower. It's not a credit qualifier because they're actually pulling equity out of the home to give to you now, and it can be lump sum or it can be payments. You can get paid to buy that home over time.
Right.
And it has algorithms. They figure out, how much they give you based on certain factors. I think your age is one of them.
Yeah.
And the home's value currently and things like that. So you get money now based on the equity in your home, and there's no payment on it. You get paid to take this loan typically. Yeah. So the math, works out a certain way. So I can go into a lot more detail on a reverse mortgage, but it's really for situations where, a borrower might be over retirement age.
Sure.
And they need money out of their property sometimes it's to pay the taxes yearly. Sometimes it's, so they can pay the taxes and insurance, and it's a means to keep them in the home, and then once they pass, that doesn't mean that the home necessarily goes to the bank. Yeah. If there's equity in that home and all these other things, that it can be taken care of by the inheritors, I should say.
I gotcha.
But again, a lot of details in here we didn't discuss.
Yes.
Because reverse mortgage has a lot of nuances, way too big for the scope of this meeting.
Yeah, it's the reverse, right? It's a completely different product than what we're used to on a normal day-to-day basis. But I did want to touch on it briefly because the word might be thrown out there. And
yeah, sure.
Like, what?
Yeah, it is a good loan for the right situation.
Right. Yeah.
But there are fees in there. There are higher interest rates and all these things because that's the cost to borrow the money and the rate at which is returned.
Yeah.
Right.
Yeah. Okay. Awesome. Sweet. Well, that's all 7. Thank you so much.
That's it?
That was it?
Okay. Yeah. Well, thank you very much for watching today. I hope you enjoyed this little segment on these 7 different loan features and functions. If you have any questions, comments, please put them down below. Like, share with someone who you might think might benefit from it. And we'll see you next time. Thanks, Nick.
Yeah. Thank you.